Hello and welcome. You're watching Business Today Television. I'm Sakshi Batra and this is the earnings special edition, and our focus is on KPIT Tech's Q2 results that have been announced. Remember, the revenue and the margin guidance is something that the company has maintained. For FY25, the revenue growth guidance is in the range of 18 to 22%. The EBITDA margin guidance has stood at 20.5%, and the company's revenue has already surged by 8% sequentially to 1471 crores, and a consolidated net profit has been flat at 204 odd crore rupees, although this has beat most of the analyst estimates as well. What we've also seen is that the company's EBITDA margin has come in at 20.8% for the quarter, and the board has also announced raising of about 2800 crores through the QIP placement as well. So let's welcome the top management to really understand some fine print of the earnings and the outlook going forward. We're now joined by Mr. Sachin Tikekar. He's the president and the joint MD of KPIT Technologies, and I'm also joined by Priya Hardikar. She's the CFO of the firm. Warm welcome to both of you, and thank you so much for taking the time out. At the outset, I'd like to wish both of you, the entire team of KPIT Technologies and all your loved ones, a fantastic Diwali up ahead. Season's greetings for this entire festive season from all of us, and we hope this year pans out to be a fantastic one for you.
So much, Sakshi, and our greetings to all the viewers as well as to you for the whole season, and wishing you all a wonderful time during the holiday season. Thank you
so
for
much. Thank you so much. Mr. Tikekar, let's start off by understanding, first up, the outlook that you've already given on growth for the second half. And, we've actually seen the stock price fall in today's trading session, probably, which is reacting to the cautious stance that the company has taken on the growth outlook. Could you explain to us what are the key reasons why you believe H2 will be in more pain versus H1? Is it the slowdown in the auto space that is probably leading you to be a little more cautious, or are there other factors, sir?
No, it's a great question, and let me just provide a little more color to it. So let's take a step back. At the beginning of the financial year, there were very few companies who gave any guidance, given the volatility in the environment. We stuck our neck out and said it would be in the range of 18 to 22%. Knowing really well that the automotive industry will go through transformation and disruption, specifically in the current year. And as we see it in the last 3 or 4 months, you see all the different OEMs across the globe, especially European ones, who are under tremendous pressure because of 3 specific reasons. One is China. There are many OEMs in China who have really good vehicles at much lower cost points. So that is putting a lot of pressure on the global OEMs outside of China. Secondly, I think the last year was a fantastic year in terms of car sales. And this year is, seasonally sort of a flattish year at best. And third thing is also the geopolitical situation hasn't been all that stable. Given all of these factors, we knew there were disruptions along the way. That's where, our range of guidance was sort of broad, from 18 to 22%. Yeah. We are happy that the results in H1 have been very strong, in line with our expectations. And we thought that the disruption largely would come in the second half. Hence, we are just saying that, we'll stick to our guidance. On the top line, it'll be on the lower end of the guidance, but on the bottom line, it'll be on the higher end. And primary reason for that is it's important for us to help our OEM clients across the globe reduce the cost of their vehicles. And one of the ways we can reduce the cost is by moving more and more work to best cost countries. That does have impact on our revenues, but it benefits our clients. It also benefits us in terms of the bottom line, right? So that's one reason of the disruption that we are seeing. And the second part is many of the OEMs, specifically the ones in Germany and Sweden as well as France, they really want to figure out what all of this disruption means to them, and who's going to be their target audience going forward, what kind of features they need, hence what kind of models and what kind of strategy they need to have. This is going to take a little more time, and we are in discussions with them in this change world. How can we help them? And we believe that this may lead to some mega engagements to companies like KPIT. However, as one would expect, mega engagements means the crafting of those engagements and those agreements are going to take a little bit longer. And that's why we thought that the H2, even though the pipeline has been very strong, it's
Yes.
actually grown quarter on quarter.
Yes.
Our number of wins have also gone up. It's
Hmm.
just that start date and some of the mega engagements are going to take another, 3 to 6 months, to sort of pan out and come to fruition. So
Hmm.
very
Hmm.
long answer to your short question, but Priya, would you like to add something to what I just said?
No, I think the focus on profitability, continues from our side.
Hmm.
As we move forward, we do believe that that focus will yield us the right results in terms of improvement in our EPS and thereby the PE for the company.
Okay. Mr. Tikekar, can you extend also to help us just give us an understanding of then if we are looking at just a cautious stance in FY25, the second half that you've just highlighted because of the key factors, how will FY26 then shape up?
Um, you know, we remain very positive and optimistic about FY26. And there are a couple of reasons for that. One is,
Hmm.
our pipeline remains healthy or it's healthier than before.
Yeah.
Secondly, the conversations are also very deep with some of our T25 clients and some of the newer clients.
Hmm.
And that gives us confidence that it may take a little bit longer, maybe 3 to 6 months for some of these engagements to pan out in a meaningful manner. But it also gives us the confidence that, there will be sort of a, solid growth coming our way in FY26. So we remain optimistic about FY26.
Okay. Let me just get Priya into the conversation, and I'd like to understand from you, Priya, on the margins front. Now, we do know in the past how you have been reporting margins of 17, 18, 19, even 20% as well. I want to understand from you, you've given a guidance which I understand, but would you see going forward from here continued levers at your hand which could expand the margins from what you are guiding at currently?
Right. As Mr. Tikekar reiterated that our guidance in terms of margin, we will better the margin that we have reiterated from a little bit more than 20.5 for the year. As we move forward, working with our clients on their cost reduction programs, our offshoring has improved. Now, what that means that translates into higher volume remaining the same. I think our margins will improve. We are also targeting to increase our FP, that is fixed price projects with our clients. That gives us the lever to improve the productivity and the build utilization. These are the classic two levers that we are keeping our head down and improving quarter on quarter. That has also led us to actually, keeping our margins intact despite the wage hikes that we did in current quarter,
Hmm.
which is almost more than 2.5% for the current quarter. So yes, EBITDA margins that our confidence is very strong, and in the near term, we will definitely improve the margin trajectory for us.
Okay, 100 basis points is how we have been seeing it grow, or would it continue to grow at that pace?
I would say it will continue to grow. We wouldn't like to mention a specific number. We will stick to our guidance, and we are very positive, as Sachin mentioned, in coming times that the ramp ups with our clients will happen, and
Hmm.
we will also grow our margins in line with our efforts in the company.
Okay.
Having said that, Sakshi, if I may just
Yes,
add to what
please.
Priya said, what is really important for us to make investments in our markets and building our offerings. So, of course, there is headroom for margins and they will improve. Having said that, we'll continue to make investments for future. So we are comfortable with the margins that we have, but our operational capabilities and efficiencies will go up, to Priya's point.
Okay. Mr. Tekakar, also get us through understanding the fundraise that you're planning, sir. How are you planning to deploy it? You have earlier articulated that, of course, inorganic acquisitions would or strategic acquisitions would be something that the company would be looking at. How and when do we continue to hear from you on that front, sir?
So usually when we get an approval from the board, it gives us about a year to do the QIP. And the current thought process is there are four areas. So what we can tell you, Sakshi, is there are four areas where we are looking for strategic partnerships, joint ventures, or any acquisitions. So one clearly is the off-highway and truck. Most of our business comes from passenger cars. Now,
That's
for
right.
the last several quarters, we've been doubling down on trucks and off-highway. And we need to build some capabilities there in order to sort of help really our clients in a meaningful manner. So one would be in that space that we are looking at. Second is in China. A lot of innovations taking place in the automotive ecosystem in China. And we believe that we can learn a lot from there and help our global clients, not only reduce their costs, but also remain competitive. So we'll make some investments in China, and we'll look at all options there. We continue to look at all options there. So that's the second area where there could be an M&A or some kind of a partnership. The third option is with connected vehicles and SDV you're talking about, the compliances, the regulations, the protection, the security of the vehicles and so forth becomes even more critical from the consumers as well as the OEM perspective. So that's another area where we think that we can create some offerings. That's the third area. And last but not the least, in cost reduction, to help our clients, most of our efforts have been in software and system integration. This is how we are delivering cost reductions to our client in a significant manner. What we think is in order to reduce the cost of the total vehicle, we'll have to do a bit more. So from system component perspective, I think we are also looking to see what can complement our existing offerings that will create more value and realize more savings for our clients. So these are the four buckets that we are looking at. But the question is, how it is with any kind of partnerships or M&A. Directionally, you're going there, but it happens only when it happens, right? So, but we hope to update you every quarter about the
Sure.
progress that we're making.
Sure. Priya, a little bit on the hiring trends going forward, and especially when we talk about the AI space, how big are you going there? There has been a continuous focus of all the tech majors on this space. How are you progressing on this front? Where do you see that growing to as a pie to your overall revenue going forward down the line? I'm talking about a long term when it comes to the resources that you will be looking at, the revenue inputs that you will be getting in from there.
Right. So as we speak, our attrition currently is one of the lowest that we have experienced, and that is a very welcoming sign. AI definitely is our focus area. We treat that as one of the tools to improve our productivity in terms of improving our profitability, and that will continue to remain our focus in our CTO organization. AI will remain a significant focus area, and we are building our competencies around it. It will, as Sachin mentioned, it will also be a significant portion of the new offerings that we are creating for our clients. And yes, it will be a major area to look for.
Okay. Also, Mr. Tikekar, if you could get us to understand a little bit on the deal pipeline from here on, what are we expecting?
We believe that the pipeline will be pretty healthy. The question is actually the pipeline is quite healthy. And as I mentioned earlier, there are some significant conversations that we are having with some of our existing clients to see how we can help them in more meaningful manner. And some of them can be really mega engagements. And the question is the closure of that. And that may take another 1 or 2 quarters to get there. So, as we get into the deep into the second half of the year and the beginning of the next year, we feel pretty optimistic about this, about the pipeline and our ability to bring meaningful closures.
Okay, just last word from you, Mr. Tikekar, and that's on the EV space, particularly the transition that we are seeing there. Are you looking at a continued pace of investment increase during this in this space? What is the outlook here, sir?
If you look at our H1, one of the biggest growth drivers for our great numbers in H1, it's actually what we call propulsion. It includes electric vehicles, hybrids, as well as conventional, internal combustion engines. So we think if you look at it, The pure battery electric vehicle, they continue to grow, but the growth trajectory has sort of slowed down in specific countries. However, many OEMs are thinking about hybrids, different types of hybrid, whether it's a plug-in hybrid or a mild hybrid, for
Yeah.
different markets, right? Given the consumer preferences. So we believe that their investment in what we call overall alternate powertrains will continue to be high, and we'll see, bulk of our growth actually coming from alternate powertrains, including EVs. So we feel pretty good about this.
All right. Well, thank you so much, Mr. Tikekar, and thank you so much, Priya, also for being with us on the show to share with us all those insights. I wish you both all the very best for the upcoming quarters, and see you around after the festivities to discuss more about the outlook in the mid-cap IT space and tech-focused companies, auto space, tech-focused companies like you. Thank you so much. All the very best. Thank you. All right, viewers, we'll wrap it up at that. That was the top management of KPIT Tech highlighting for us what has worked, where do you think the pain can continue to be there, why the cautious stance in H2, and why do they actually believe that the outlook continues to remain positive, and it remains to be about the guidance on the revenue part and on the profitability part, where they actually expect to go forward with the higher end of the guidance going forward from here as well, and all the other factors and levers that will be continuing to work for them to improve the numbers from here on. Many thanks for being with us on this edition, but do stay tuned. Business Today Television will continue to get you all the key highlights from top management from all the companies that are reporting their earnings.
After over 4 years in a frozen war-like situation, 17 meetings at the diplomatic level, and 21 border meets between the two armies, a surprise declaration from the two sides, locked in the world's biggest military standoff, India and China unveil a big step forward. A day after India announced a jointly achieved